The economy is not immune to recessions, and when recessions occur, it spells trouble for your portfolio. With the economy shrinking, markets declining, and risky assets depreciating, the impact can be significant. However, certain sectors remain relatively resilient to economic fluctuations. Seasoned investors favor these sectors during downturns as they offer stocks that either perform well or experience less declines in value. Recession-resistant stocks are defensive in nature, able to sustain growth or limit losses even during economic turmoils, as their products or services are always in demand. Top recession stocks consist of consumer staples, healthcare companies, and utilities, all offering goods and services that are essential to consumers, regardless of economic circumstances. With many experts predicting the economy will enter recession soon, here are 9 of the best recession stocks for your investment portfolio. They are all from defensive sectors, boast consistent growth, outperform over 90% of stocks during bear market recessions, and exhibit greater stability than most U.S. stocks. PepsiCo, PEP. PepsiCo is a major global company known for its beverages and snacks, with popular brands like Pepsi, Gatorade, Lay's, and Doritos. The company has maintained strong earnings growth exceeding 15% annually for the past 5 years. However, analysts predict a slowdown to around 8% over the next 5 years. Pep has experienced steady growth, leading to lower volatility, with the largest decline in the past decade being 30%. PepsiCo has slightly underperformed the S&P 500 over the last decade, with an average annual gain of 12.1% compared to the 12.6% of the SPDR S&P 500 ETF. Now, if you are seeking dividends, consider this. PepsiCo has consistently increased its dividend payout for over a decade and currently yields 2.96%. Pepsi's dividend grows by approximately 7.4% annually, and the company is a member of the Dividend Aristocrats. Next on the list, Merck & Company, Inc., MRK. Merck is a pharmaceutical company that specializes in developing products and vaccines to treat various diseases in humans and animals. Merck has experienced steady growth over the past 10 years, with analysts expecting this trend to continue. Over the past 5 years, the company's EPS, or earnings per share, has seen annual growth averaging 47%, and forecasters expect to see growth nearing 12% on average for the next 5 years. This is the highest growth rate among the companies on our list. The most significant price drop in MRK in the past decade was 28%, while over half of the S&P 500 stocks experienced declines of more than 50% during that same period. Despite its lower volatility, Merck has outperformed the S&P 500 over time. In addition, Merck pays a respectable dividend with an average annual increase of 6.7% each of the last 5 years. Becton Dickinson and Company, BDX. BDX manufactures and distributes a wide range of medical and surgical products, things like syringes and needles. Over the past 5 years, the company has experienced a nearly 33% increase in its annual EPS, and analysts anticipate earnings to grow by 9% annually over the next 5 years. Shares of the company has experienced limited declines, reaching a maximum of 30% over the past decade. While this might appear significant, it reflects considerably lower volatility compared to most stocks. Becton has a decent dividend yield that has grown by 4% annually over the past 5 years. In fact, BDX is a member of the Dividend Aristocrats, with 48 consecutive years of dividend increases. CMS Energy Corporation, CMS. CMS Energy supplies natural gas and electricity to consumers in Michigan. It is a consistent, strong performer with annual earnings growth exceeding 10% in the past 5 years. Forecasters anticipate annual earnings growth north of 8.2% each of the next 5 years. In the past 10 years, the company's most significant price decline was 30%, yet it managed to slightly outperform the S&P 500 over that same period. The company offers one of the highest dividend yields among the companies on our list, and in the last 5 years, its dividend payout has grown at an average annual rate of 6.8%. Xcel Energy, XEL. Xcel is the second electricity and natural gas provider on our list, with operations in several states. Over the past 5 years, the company has grown its earnings at 6.5% annually. Analysts anticipate that this growth trajectory will continue over the next 5 years. XCL's largest decline in the past 10 years was 30%, but it has modestly outperformed the S&P 500 during that period. Xcel Energy has the highest dividend yield of all the companies on our list. It has consistently increased its dividend payout for 21 consecutive years, with an average growth of about 6.5% in the past 5 years. Ameren Corporation, EEE. Ameren is the leading electricity producer and natural gas distributor in Illinois and Missouri. Despite recent market volatility, Ameren has successfully increased its earnings by 13.3% on average over the past 5 years. In terms of volatility, this stock aligns with others on our roster, with its most significant loss within the past decade of 30%. AEE has outperformed the S&P 500 by 1.2% on average over the same period. Ameren pays a healthy dividend, which it has grown steadily by 6.7% annually over the past 5 years and by over 5% for the last decade. Amgen Inc., AMGN. Amgen is a biotech firm specializing in developing medications to treat cancer, kidney disease, inflammatory conditions, and more. Over the past 5 years, the company has achieved remarkable earnings growth, averaging nearly 36% annually. However, analysts predict that this growth rate will decrease to just 5% per year in the future. When it comes to price stability, Amgen is the most reliable stock on our list, with its largest price drop in the past decade being only 25%. During this period, AMGN has slightly outperformed the S&P 500. The company's strong dividend yield makes it an exceptional option for income investors. Over the past 5 years, Amgen has increased its dividend by an impressive 11% annually. Thermo Fisher Scientific, TMO. TMO is in the healthcare sector and specializes in scientific research equipment. It stands to benefit from potential increases in research activities. Analysts forecast that TMO's annual earnings growth will slow to approximately 6.63% over the next 5 years, down from the 26% per year it experienced in the past 5 years. TMO stands out for its stock performance. It is the top recession-resistant stock on our list, as it has outperformed all others. Thermo Fisher Scientific has consistently delivered an average annual return of over 23% over the last decade, outpacing the S&P 500 by approximately 13%. Unfortunately, TMO's dividend performance has not been consistent with its share performance. It pays the lowest dividend on the list, 0.3%, but it has the best dividend growth rate. Over the previous 5 years, dividend payouts have climbed by an average of roughly 15% every year. Danaher Corporation, DHR. The Danaher Corporation is a global science and technology company that designs, manufactures, and sells professional, medical, industrial, and commercial products and services. DHR's 5-year earnings growth prospects are the lowest on our list, which is a significant decline from the 24% annual EPS growth delivered the past 5 years. In the past decade, the stock has consistently outperformed the S&P 500 by more than 7% annually due to its recent growth. Although it offers a low dividend yield of 0.4%, DHR's average dividend growth rate is 12.3%, the second highest on our list. Recessions are inevitable, so you must build a truly diversified portfolio that can withstand economic downturns. The key to achieving this is to invest in companies across various sectors, including recession-resistant industries. Please leave us feedback and share your thoughts in the comments. And if you found this information helpful, smash the like button, subscribe to the channel, and share the video. Until next time, stay financially savvy. We'll see you in the next video.